The most important consideration when trying to decide whether to buy or lease a new car is the residual value that they offer you in the lease agreement. The residual value is the price at which you have the option to purchase the car at the end of the lease. And the residual value is specified in your lease agreement at the time you take delivery of the new car. So it's fixed up front. At the end of the lease, which could be, say, 2 or 3 years later, nobody really knows what the used car market is going to be doing. Nobody really knows what the value of that car on the market will be. If the value of the car on the market is higher than the residual value, then you might decide to purchase it and you still get the residual value price, which is a good deal. But if the value of the car on the market is lower than the residual value, then you just put the car back on the dealer and you let the leasing company take the losses. This option is the single greatest advantage of leasing versus buying, because when you buy, you take all the market risk. But when you lease, you get to keep the upside of the risk. The leasing company takes the downside of the risk. So it'll be interesting to see what used car prices are like. How volatile, how unpredictable, what is this option worth? And fortunately, the Manheim Company, largest operator of used vehicle auctions in the United States, provides us with data about the prices paid at their used vehicle auctions. Here's, say, the last 13 years, and you can see written into this graph some of the biggest socioeconomic events of our time. You can see, for example, the dot-com bubble, and used car prices were really high. You can see the dot-com crash, and used car prices came down with it. You can even see the 9/11 attacks. Although used car prices had recovered somewhat, those attacks undermined confidence in the economy, and people retrenched instead of making new purchases. Used car prices recovered pretty well until the Great Recession, the financial crisis of 2007, 2008, when so many people went bankrupt or were underwater on their homes that they couldn't get approved for new loans. It was the Cash for Clunkers program in 2009 that helped accelerate the recovery of used car prices, and you can see that they came all the way back above the dot-com highs by 2011, peaking here in the early spring. Well, what happened after that? It looks like used car prices were fairly stable, but the leasing companies and the automobile manufacturers were so enjoying this rapid increase in price that they wanted to make a new gamble. They increased the residual values on the leases that they offered in 2012. And when your lease contract has a higher residual value, it means that your leasing monthly payments are going to be lower. To encourage people to lease new cars, the leasing companies and automobile manufacturers made a guess that the used car market would keep going up after 2012. And that guess boosted their profits during this time when they leased cars based upon these attractive deals. But what happens after 2 or 3 years when the cars that they leased here, based upon the inflated residual values, come off lease? It turns out that prices didn't keep going up, and the consumers whose cars were coming off lease in 2014 and 2015 noticed that the residual values were higher than the used car prices. So they didn't buy the cars at the end of the lease. They just put them right back onto the dealers and to the automobile manufacturers and the leasing companies, all of whom took big losses. Those losses got so bad for some of the companies that their chief executives were fired. Here, the CEO of Hertz, December 2016, axed, because Hertz is one of the largest used vehicle sellers in the United States. They buy new cars in bulk, and then they rent them out for a year or two, and they expect to get a certain used car price at auction when they're done renting. When those prices failed to materialize, the Hertz losses got so bad that they decided to make this executive change. It wasn't until May 2017 that the Ford CEO was fired for similar reasons. And then a funny thing happened. What is this tremendous spike in used car prices that happened during the summer of 2017? And the answer is, it was the hurricanes. Particularly Hurricanes Harvey and Irma wiped out about 1 million used vehicles, destroyed. The drivers then had insurance company payments and a real need to replace their vehicles right away. They bought used cars, they bought new cars, they leased new cars, and the used car market responded to the destruction of supply that the hurricanes created. It was too late to save the Ford and Hertz chief executives, but since then, both companies have recovered in part because of the increase in used car prices. So the question for you, if you're thinking about buying or leasing a car today, is, well, what's going to happen to the used car prices relative to my residual value? And fortunately, Manheim gives us some data on residual values too. What they're doing here is comparing the prices paid at their auction to the Federal Reserve data on new car prices 3.5 years ago. They're trying to get an estimate of how well these residual values played out. You can see at the depths of the financial crisis, the actual used car prices were about 40% of the new car prices 3.5 years earlier. But remember that January 2011 peak? By then, the used relative to new car prices from 3.5 years earlier was up over 50%. Look at what's happened since then. Residual values have gently, sort of slowly come back down to below 50%. Right now, they're sitting here at maybe 47% on average. In a previous video, I showed you how the residual value offered in a Subaru lease was almost 65%. The lease offered for the Subaru Impreza at the end of 2017 said you can purchase the car for 65% of the agreed upon value of the vehicle at the time of leasing. If the Subaru loses value more than that, if it turns out to be like an average car down here around 50%, or maybe it retains its value even better, 55%, then the used car price at the end of the lease term is going to be below the residual value. You won't purchase it for this inflated price. You'll simply put it back to the dealer and let them take the loss. In the meantime, your lease payment is calculated on the depreciation, the difference between the agreed upon value of the vehicle and the residual value at the end of the term. And that means the lease payments offered by that Subaru lease are very inexpensive because they're assuming that the depreciation is small and the residual value will be high. That assumption might not be good. That assumption might be great. It doesn't matter because the leasing company takes the risk of the plunge in used car prices. If used car prices stay high, you get all the benefit. And that is the principal advantage of leasing. To determine whether you're getting a good deal on your lease, take the residual value, divide it by the agreed upon value of the vehicle when new. Determine this ratio. If it's better than 50%, then you might be getting a good deal. If it's worse than 50%, then your lease payments are probably too high and you should look at buying the car or look for another model.